Hello and welcome to the market update for the month of March with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. How was March for you, Andrew? Another month in the books?
yeah, another very positive month, although the weather wasn't that positive, was it, Dan?
It wasn't. No, it wasn't.
Especially with those
Any
people.
which way.
Especially with those people looking for a little bit of early spring sunshine.
It didn't happen, did it?
It really didn't. No.
Well, we move on.
We do. Onwards and upwards. So March actually was a very positive month. So I think actually when we look back at that's about 3 months in a row. And it's the first time in over 3 years where all of the funds within the range that we look after had actually seen positive growth. So over 3 years. No, actually getting on for 4 years since that's happened. So very, very good. And we don't need to, at the end of it, when we give in the updates, we don't need to include 0.1% or 0.2 just to try and make the figures look even more encouraging, because we have some quite good positive numbers.
It's good to hear that everything's been a positive for the month of March. And how did the US perform? They usually do really well.
Yeah, it was another good solid month, and I think follows the previous few months where we're seeing really good employment numbers. Fears at the beginning, I think, of the pandemic were that millions and millions of people were going to lose jobs and it was going to take ages and ages and ages to recover. Well, that just hasn't happened. The employment rate is, really almost at an all-time high, which is good. Consumer confidence is continuing to increase, which is very good for demand. And inflation, although still above target, just over 3%, is containable and is within grasp. The Federal Reserve, the lovely people over there, show no signs of wanting to reduce interest rates anytime soon, probably because of the fact that inflation is still above target, and the prime reason for this is because the Federal Reserve, like all the other central banks more or less around the world, increased interest rates, which makes inflation last for longer, as we've kept saying for months and months, if not years.
Yes.
But very good numbers out of the US, and Wall Street's now seeing 5 months in a row of positive returns from most of the indexes. And the S&P 500, for example, has put on just over 25% growth in 5 months. So really encouraging numbers out of the US. And the other good thing to note during March was that the rally is broadening away from just the major 7 players and away from just the artificial intelligence top companies. So it's getting more broader in its recovery. So we're seeing good things, and indeed the US, one of our particular funds, showed the highest growth from any of the funds over the last 4 years for the month of March. So a very, very good position, and probably justifies the reason why a lot of people are moving money over to the States to look for better returns and consistent returns.
It's all hunky-dory in the US. How is it over next to our friends in Europe, EU?
Yeah, the Europe, excluding the UK, did, again, another good month, a solid month. Inflation starting to come down across the Eurozone, especially in Germany, although production there is still slow because of the world slowdown. But nonetheless, the Stoxx 600 index, the 600 largest quoted companies that you can buy shares in, they roared ahead during March, putting on really, really good returns. So if you know where to look, Europe ex-UK is the place to be. So a very, very well-regarded market. It's well-regulated, lots of information, freely tradable, and some companies that have good worldwide potential for growth, different sectors, not just concentrating on IT, but over the sphere really, through to healthcare, food, technology, etc. It's all looking reasonably good actually, which we're not used to saying this, are we? I mean, after 2022, 2023, gosh, yeah. Anyway, it is a good position for Europe. Looking at some of the figures that have come out for 2023, because it takes a while for figures to get adjusted, Europe's fastest growing economy was actually, I'm not going to ask you this, Dan, because you'll know the answer already, but it was Montenegro, or Montenegro, depending how you want to pronounce it. Their economy grew by 4.5%. Well done to them. The European country with the worst growth, no, it wasn't the UK, thank you very much. It was Estonia. Oh, yes. That lost by 2.23%. Interestingly, when we're looking at the figures, Ukraine, their economy grew 2%. So it was a good year for grain harvests, and in fact, a lot of the exports from Ukraine weren't that badly affected, although obviously the country has gone through dreadful times. Unemployment, it's high in some areas of Europe, especially in Spain.
Oh,
where it's
too much rain there.
Probably is actually just over 11% seasonally adjusted. That's a very high figure.
It is, yeah.
Which is very, very good if you're looking for a job there. Compare that to your home country.
Oh,
which one of the many?
Which one am I picking today? Well, you're in Europe, so I'm guessing Poland.
Yeah, you're right. With under 3%, German and the UK just over 3%. So yeah, starting to actually come down. But many parts of Europe, unemployment starting to fall slowly, but still high in one or two areas.
We've done Europe and the US. Why don't you come home to the UK and see how we did here last month?
Yeah, so the UK for last month, it was a good month for large and small, medium-sized companies, showing positive growth. We're still lagging behind the rest of Europe and the US in terms of growth. The FTSE 100 is getting close to its all-time high of 8,014, which was way back on the 20th of February last year. But it seems to get hover near the 779 mark, and then can't be bothered, and it goes back down again. So, but as China starts to improve, we're going to see a lot of the big mining companies, which the FTSE 100 is heavily influenced by. They're going to start coming and showing some better returns. So we'd expect decent things towards the end of the year. House prices are up over the last year on year. Consumer spending is strong. Confidence is starting to return. Employment, as we said a few minutes ago, is very, very good. The percentage of people in work is actually near all-time high. Inflation, still, like the US and Europe, is still high, but it remains high because of the decisions by the central bankers to raise interest rates, and it keeps inflation higher for longer. But it's I think it's a good steady picture. The election, the end of this year, perhaps, well, the market, I don't think it's fretting too much because of the fact that the two major political parties, there's not that much to choose between the two of them in terms of what they're telling journalists regarding the stance on things like taxation and other bits and pieces which could help with the economy. Some early indications, perhaps the Bank of England might reduce its interest rates before those over in the US, which will be somewhat of a first, but it'd be quite nice if the UK could take the lead and say, look, this high interest rate period is perhaps coming to an end. Rates aren't going to get down to anywhere near the 0.25% that we saw before the pandemic. I think they'll sort of fixed around about 3.5%, but they need to come down just to give us a bit of a stimulus. The UK generally, yeah, it's a good picture, and we remain positive.
Let's us discuss the major players. So why don't we look at the rest of the world then and how they fared last month?
Yeah, so if you look at our friends over in Japan, so as expected, the Bank of Japan ended its negative interest rate policy. It's been doing that for a number of years. Bit of an experiment. Don't think I think it really did them any good, but they're seeing a boost now. We're getting a bit of growth. In fact, the topics, which is like the FTSE over there, nothing to do with the topics sweetie bar, but that's completely different. That reached record heights and was actually the best performing index of all countries' indexes in the world. So it actually did very, very well in March. So we're seeing good growth in Japan, long overdue, may I add. So if you've invested with them for the last 30 years, you're probably still looking to see a profit. But anyway, there we are. I thought we'd have a look in Zimbabwe.
Oh, yes.
Yeah.
It's not raining there.
Isn't it? Right, okay. Well, its currency, as you know, is the Zimbabwean dollar, and that's fallen year to date, putting this together, by 73% against the US dollar. 73%. The economy's in a real state over there. But my word, it's only worsened, or it's only beaten, depending on which way you want to look at it, by the Lebanese pound, which is down around about 80% year to date against the US dollar, which is quite amazing considering we're only talking about March, so the beginning of the year. So anyway, China, so they're steaming ahead now. Write China off at your peril. A lot of analysts were doing that towards the beginning of the year. Well, my word, it looks like their target of seeing 5% growth for the year is going to be met. And if you consider the UK had zero growth last year, and what we're talking about there, what Montenegro having 4.5%, the best that Europe can offer. China last year put on over 5%. This year looks like it's going to do the same again. So it's showing a real positive growth once again. Consumers are feeling a bit better. Their indebtedness is starting to fall, and manufacturing for the first time in quite a few months has actually started to pick up as well. So China is starting to come alive again, despite all the impositions and trade tariffs that America is throwing at them to try and restrict, especially their technology. But EV cars in particular are the way forward for China, I think, and they're going to dominate that sector before too long. Well, they're already a major player in it, but doing very, very good things over there. So all in all, it was a very, very good March. And I thought as well, we'd just have a look at investment funds generally, where they've been able to double your money over a 5-year period. And the two areas that actually the funds, the general funds that could do that or have done that are USA and also then Europe, excluding UK. So if you'd have been invested in either or any of the European stroke US funds that we recommend, you'd have done quite nicely over the last 5 years, despite the dreadful effects of COVID-19 on the world. So there we are.
And as we do every month, we'll have a look at the ARD consultancy portfolios and their performance. And we'll look at the 1 month period, 1 year, 3 year, 5 year and 8 year period. And we'll start with the defensive portfolio.
This month up 2%. Over the last year up 9%. 3 years 6, 5 years 22, and over 8 years up 49%.
And the cautious portfolio?
This month up 2. Over the year up 10. 3 years up 10. 5 years up 31. And 8 years up 72%.
And the balanced portfolio?
This month up 3. Over the year up 13. 3 years up 13. 5 years 44. And 8 years 99%.
The capital growth portfolio?
This month up 3. Over the year up 14. Over 3 years up 15. 5 years up 53. And 8 years up 122%.
And the aggressive portfolio?
This month up 3. Over the year up 15. For 3 years up 18. 5 years 61. And 8 years 145%.